Imagine this. A travel tech giant that once struggled is now on the verge of a major comeback. Saber's stock is trading at historic lows, but analysts see an 88% upside heading into 2026. With a stronger balance sheet, growing revenues, and a $2.85 price target, this could be one of the most compelling turnaround stories in the market. Is Sabre the hidden gem investors have been waiting for? Let's dive in. Sabre is a global leader in travel technology solutions, is emerging as one of the most intriguing turnaround stories heading into 2026. After years of volatility driven by pandemic disruptions and restructuring efforts, Sabre has made significant progress in stabilizing its operations, strengthening its balance sheet, and positioning itself for sustainable growth. With its stock currently trading at historically low valuation multiples and analysts projecting substantial upside, Sabre offers a compelling case for investors seeking undervalued opportunities in the travel technology sector. The company's fundamentals, strategic initiatives, and improving financial metrics suggest that 2026 could be a breakout year. One of the most notable indicators of Sabre's potential is the average analyst price target of $2.85, which represents an 88% increase from the current share price of $1.51. This level of projected upside is rare for a company of Sabre's scale and market presence, signaling strong confidence in its recovery trajectory. Analysts are factoring in improved financial health, revenue growth, and margin expansion, all of which suggest that Sabre is on a path to regain investor trust. For those seeking asymmetric risk/reward opportunities, this price target alone warrants a closer look. Sabre's balance sheet improvements have been a cornerstone of its turnaround strategy. The company currently holds $682 million in cash, providing a robust liquidity buffer to support operations and service debt obligations. This cash position is particularly important given the company's recent strategic moves to extend debt maturities. Following the sale of its hospitality solutions business, Sabre successfully pushed 60% of its debt maturities beyond 2029, significantly reducing near-term refinancing risk. This restructuring not only strengthens the balance sheet, but also gives Sabre the flexibility to invest in technology and innovation without being constrained by looming debt deadlines. In an industry where capital intensity and cyclical demand can create financial strain, Sabre's proactive approach to debt management positions it well for long-term stability. Operational performance has also been encouraging. Sabre reported quarter-over-quarter and year-over-year revenue growth, reaching $715 million in Q3 2025. This growth reflects a rebound in travel demand and the company's ability to capture market share through its technology solutions for airlines, travel agencies, and other partners. Looking ahead, Sabre is forecasting 6 to 8% top-line revenue growth in Q4 2025, which, if achieved, would reinforce the narrative of sustained momentum heading into 2026. In an industry where demand can be volatile, consistent revenue growth is a strong signal of resilience and operational execution. Profitability metrics are moving in the right direction as well. Sabre experienced 23% growth in earnings before interest, taxes, depreciation, and amortization (EBITDA) in Q3 2025, underscoring its ability to scale earnings even as it navigates a competitive environment. Additionally, operating margin, a key indicator of efficiency, has improved significantly. Sabre achieved negative 8% operating margin in Q3, the best level since 2020. While still negative, this trend suggests that the company is steadily moving toward break-even and potentially profitability in the near future. For investors, margin improvement is a critical factor that often precedes sustained stock price appreciation. Valuation metrics further strengthen the bullish case. Saber's price-to-sales P/S ratio is at its lowest level in company history at 0.21, down from 0.48 at the start of the year. While part of this decline reflects the divestiture of the hospitality solutions business, the ratio remains historically low even after accounting for that adjustment. This deep discount suggests that the market may be overly pessimistic about Saber's prospects. In addition, the company's price-to-book ratio has been improving every year, reaching its highest level since 2020, a positive signal for long-term value investors. These valuation trends indicate that Saber is not only undervalued relative to its historical norms, but also compared to peers in the travel technology space. Sabre operates in a sector that is inherently tied to global travel demand. While macroeconomic uncertainty remains a risk, North American travel demand has held up well, and Sabre's technology solutions are deeply embedded in the industry's infrastructure. The company provides mission-critical systems for airlines and travel agencies, making its services essential rather than discretionary. This positioning gives Sabre a degree of resilience even in challenging economic environments. Furthermore, as travel continues to recover globally, Sabre is well-positioned to benefit from increased transaction volumes and higher demand for digital solutions. Several catalysts could drive Sabre's stock higher in 2026. Continued revenue acceleration, margin expansion, and debt management improvements will enhance investor confidence. At a P/S ratio of 0.21, Sabre is priced for distress. Any positive surprise, earnings beat, revenue uptick, or strategic partnership could trigger multiple expansion. Industry tailwinds also play a role. If North American travel demand remains robust and international markets continue to recover, Sabre could see a surge in transaction volumes. Additionally, the company's ability to generate free cash flow provides a cushion against macroeconomic volatility and supports reinvestment in growth initiatives. Of course, risks remain. Macroeconomic uncertainty could impact global travel demand, and competitive pressures from other technology providers may affect pricing and margins. Execution risk is another factor. Failure to achieve forecasted revenue growth or margin improvements could weigh on investor sentiment. While debt maturities have been extended, Sabre still carries significant leverage, which could become a concern if cash flow deteriorates. Investors should monitor these variables closely when considering an investment in Sabre. Despite these risks, Sabre represents a classic turnaround opportunity. A well-established company with improving fundamentals, a strengthened balance sheet, and historically low valuation multiples. The combination of analyst projected 88% upside, operational improvements, margin expansion, and strategic debt restructuring makes Sabre a compelling candidate for investors seeking value and growth potential in 2026. While patience and risk management are essential, Sabre's trajectory suggests that the worst may be behind it. It would not be surprising to see Sabre's stock approach 3 per share, nearly doubling from current levels. For those willing to look beyond short-term volatility, Sabre could be one of the most rewarding plays in the travel technology sector as we move into the next year. In conclusion, Sabre stands out as a legitimate contender for a strong 2026. Its improving financial health, revenue growth, margin progress, and attractive valuation create a favorable setup for long-term investors. While challenges remain, the underlying fundamentals suggest that Sabre is on the right path. For investors seeking a turnaround story with significant upside potential, Sabre offers a compelling case. With strong liquidity, operational momentum, and strategic positioning, Sabre could deliver substantial returns for those who recognize its value before the market does.